Good morning, everybody. Welcome to the Flow Show. And just make sure my squawk's off. There we go. I hope you're all doing well. Got some moves again today. The yen really seeing some action right now, but lots of things going on, which we'll get through. Excuse me. Just want to give you a little heads up, though, for tomorrow. There may not be a Flow Show tomorrow. I've got an appointment that I need to take care of in the morning. So there's a possibility I won't be back in time. So unless I can get anyone else to cover it, we might be bidding off the Flow Show tomorrow, but we'll let you know in good time. Anyway, right, let's get cracking. Lots to talk about over in Japan. Ueda's been waffling on again, been speaking in Parliament, been speaking in an interview with the FT, says he won't comment on specifics on interest rates, but says long-term interest rates are rising rather rapidly recently. He says they're going to raise rates if the economic outlook is realised. That's the same old line, but says that Japan's real rate is still very low. They'll make the appropriate decision at the December meeting. They're actively gathering information on wages momentum. And that the likelihood is rising gradually for the outlook, and says that an adjustment will be a gradual adjustment to support long-term growth. We've had a bit of data out from Japan as well. Machine tool orders, flash numbers year on year up 14.2%, so still nice and healthy there. Japan's Foreign Minister Motegi says that they will correct any misunderstandings with China, which seems to be a comment pointing towards de-escalation in the situation, the bum fight that's been going on over there. So we'll see if that draws any attention or leads to anything. The RBA, they kept rates unchanged at 3.6% as expected, but a quite significantly hawkish tilt to the meeting overall. The decision to keep rates on hold was unanimous in the statement. It says recent data suggests risks to inflation have tilted to the upside, but the persistence is still being assessed. RBA's Bullock, speaking afterwards, says there needs to be cautiousness interpreting the monthly CPI series. Says recent data suggests the economy may be tightening. She says inflation and jobs data are key for February meeting. Then she said they did not explicitly consider the case for a rate hike, but they did not consider a rate cut either at this meeting. They discussed circumstances in which further tightening may be needed. And says that persistent inflation would raise questions for policy. She said further rate cuts are unlikely given the underlying momentum in the economy, and the outlook is for an extended pause or hikes, but would not put a probability on it. Says if data shows inflation is not slowing, they will consider that at the Fed meeting. So this is a quite hawkish tilt from the RBA. Probably one of the banks, given Bullock's history and given what's been happening there with them pausing on rates, probably one of the banks which you might expect to tilt hawkishly, but it's still a bit of a shock to get that sort of confirmation anyway. We were musing in our room yesterday, looking at all these yields rallying globally that we've been speaking about, whether there was a possibility that the market is perhaps looking at the possibility of rates going back up again in various countries, particularly those where rates are on pause. The ECB are one, they're on pause. Inflation is looking a little bit sticky again. The RBA, similar situation, but with a bit stronger inflation. Bank of England still can't get inflation down. Now, as we're always telling you, the market trades more the expectation for the future than it does trade what's happening now. It's looking ahead to next year, what's going to happen with rates, and it's possible. I'm still a little bit skeptical. That's the reason for this yields move, but it's possible that the market is coming around to that way of thinking, and the RBA have just added another little bit to that trade as well. Of course, this could all just be seasonal stuff, year-end stuff, Fed stuff, holiday stuff, all the usual palaver we get this time of the year. So I don't think we can make any conclusions, but it's worth noting all these little elements that may impact the market moving forward. It's best to have an idea of them now and rule them out later than ignore it and it becomes something later on. So just one of these possibilities that might be entering the market. And if that is the case, then that can bring next year's early moves in markets. So we'll keep an eye on that as it develops and see what the market wants to do with that over the days ahead. We had Bank of England's Taylor speaking as well, saying the foot is still on the brake a little bit in terms of rates, as wage inflation and services inflation is coming down. Apparently Rachel Reeves's budget has hit the Bank of England as well, because they're planning staff cuts due to the budget, and they're looking for staff to take redundancy. So no one's missing out on the mess that Rachel Reeves has dropped on everyone, even the Bank of England having to adjust to it as well. Over in Germany, they're apparently going to approve 52 billion euros in military orders. So that's part of all their big defence spending stuff that we all knew about. So that's starting to filter through. Over in the US and inflation expectations from the New York Fed. So 1 year inflation expectations coming down to 3.2 from 3.24. 3 year and 5 year expectations stay unchanged at 3%. Mr. Hassett, he seems to be toning himself down a little bit and, dare I say it, presenting himself as a bit more of a stable potential Fed head. Some of his recent comments, particularly these ones, he said we should continue to get the Fed rate down some. Says that Powell probably agrees that it's prudent to cut rates. He says that laying out a 6-month rate pledge would be irresponsible. Says it looks like Powell's done a good job herding the cats. He also indicated that Trump will be messaging on the economy this week. Apparently some big announcements coming. Trump has put forward some subsidies for farming, and he's going to do some other changes and potentially tariff Canada on fertilizers and stuff like that. But we'll wait and see what this big announcement is. But back to Hassett. Yes, he's trying to calm the markets down probably if he's going to get this job, because the market wasn't best pleased when he became front runner. But as I say, last week he was talking about the Fed cautiously lowering rates and how 25 pip cuts seem appropriate, which is certainly a departure from Mr. Mirren, who's in place at the moment on the Fed board. So who knows? Still to be confirmed. We'll have to wait and see. We had a 3-year note auction in the US, which had a lower bid to cover, 2.64 versus 2.85, but had a big take up in indirect, 72% from 63% previously. So we can call that one pretty good. Going over to the Fed, obviously, we've got the Fed tomorrow, FOMC tomorrow. And just as I mentioned, we've got this big potential reprice around central banks, the market potentially looking at what's coming up next year. So, well, starting with the Fed, Standard Chartered, literally 2 days before the FOMC, now sees a cut coming on Wednesday versus their prior forecast of no cut. About the only chance these banks have got of getting their forecast right if they present them 2 days before the event in question. Over to the ECB, and again, this may just be reflective of some of these yield moves we've seen. Early in the day, traders priced in less than a 10% chance of a 25 pip cut in 2026. Then later on, we were pricing a 20% chance of a rate cut by the end of 2026. So we're seeing a bit of movement in the rate expectations. Market also pricing in less than 75 basis points of cuts by the end of next year. Also, Man Group crossed the line already. We knew it was coming. They say that QE may be needed if the market queries whoever becomes the new Fed chair. Talking about that, we expect QE to rear its head. That is something that may pop up at the FOMC. We know that the Fed is going to be getting into rebalancing their balance sheet, which would include buying bonds, but that's not QE. That's just balance sheet management. But as we've been saying, there's going to be people in the market who are going to call it QE, say that QE is coming and whatever. So who knows what's coming back, but that most of it's going to be bollocks. We heard it first. As far as the data goes, the BLS are still in a bit of a pickle. They are not going to publish the October PPI data now. They're going to hold it off and publish it with the November data in January. That's coming the 14th of January alongside some other data as well. So still all over the place with that. 1 month or whatever it was, 44 days of shutdown, and takes 6 months to wash it all out. Over in Ukraine-Russia situation, Zelensky says there is no accord so far on the Donbass area in US talks. This is the current sticking point, or one of the sticking points, in terms of what territory Ukraine might be asked to give up, Donbass being the region in question. But he says pretty much that's not up for talks, or not going to be part of the plan. He was in London yesterday as well, says talks were productive. There is small progress towards peace. And that Ukraine-Europe plan should be ready to share with the US today. So we'll see what Trump thinks of that. That situation is still ticking over. That's about it from the major headlines. Kay's not here to ask if he's got any more. So if you've got any headlines, why don't you pop them up in the Zoom chat there, and we can talk about it. Anything you've seen in markets that you feel relevant to be discussed. Stephen, so yeah, I could have Mr. Brown do the show tomorrow. I actually had him coming on tomorrow anyway, but I think it's a bit cheeky to ask him to cover the full show for me. But well, I might do. He's not doing anything else. He's already, as we all know from our chat room, he's already proclaimed that the year is over. So he's sitting twiddling his thumbs. Maybe I'll get him to do some work here. But yeah, he was scheduled to come on, but he's not now. Right, let's have a look. Now, probably the surprising thing is that even though we've had this hawkish turn from the RBA, the Aussie dollar hasn't managed to motor on. It's obviously looking fairly well bid still, but I would have thought, with given some of those lines, that potentially a hike is on the cards in February. Aussie dollar might have done a bit more. That's the case in the crosses as well. But keeping on Aussie dollar, we couldn't break this resistance that we had yesterday, 64.50s, around that area, which is a bit of a surprise. Doesn't mean it can't go on and do it, but I thought we would have been flying through there on all that news. So if we can't do that, then it keeps potential pullbacks in play. This 66.30s, 36 level around here, that's looking a bit pivotal at the moment. We're trying to hold it. While it does that, the longer it does that, then the greater the chance we're going to have a break up, and we're going to be heading towards the 67 level. But if we're back below this 66, 30, 35 area, whatever you want to call it, we're probably going to have another look down towards the figure, maybe as a little bit more to go. But obviously, this one's got heavy influence from the US dollar as well at the moment, which has been weak. That's seen a bit of a reverse, so it's really all over the place, this one. But yeah, I think the key from here is that it isn't higher following the RBA or breaking new highs. Aussie Kiwi, similar as well. Couldn't even get to last week's highs after the RBA. Did have a bit of a strong move though, so it has done a fair bit on what is really an unchanged monetary policy stance. So maybe the FX market is not believing too much about the rate narrative, and that hikes are potentially coming from central banks in the future. But again, that's just all speculation. who knows? We could just be seeing end of month, end of year flows, pre-Fed flows, whatever you want to call it. There's a lot of uncertainty over what's driving some of these moves. If we're looking at bond yields as a whole today, let's go into my little bond thing. Across the board, we're holding a bit steady. We had obviously these fairly strong moves yesterday. They're all holding up where they were, but we're not seeing any extensions now, anything really building on some of these moves. So maybe that was just a one-off thing yesterday that we saw a little bit of position adjustment maybe. But we need to keep an eye on it, some of these yields, just to see if they do kick on again. But we're seeing a little bit of a pullback. Now, as mentioned, the yen is kicking on. Talking about this in our chat room. We've had dollar yen screaming up into the 156s. A very early move here. That's despite what Ueda was saying. So, I mean, I think it's pretty much baked in that we're going to get a hike. It still will be a little bit of a shock if we don't get one at the December meeting. So that's what you need to look at for the price risk. But if we ain't getting it in December, we're probably getting it in January. So either date is open. But this one is looking strong, and it's being driven mainly by what's going on in the crosses. We've had a bit of a pullback, but some of these crosses were moving up into big old areas. Now, I'm going to look at euro yen, if I haven't lost it. Have I lost it? Let me have a look. No, it's still there. Because we got some big old multi-year levels coming up in this one. We've got this fib, which we're at the 50 retracement, call it 187. But if you go back here, you'll see it's a bit of an area, a significant top way back in the 1990s. Okay, so this fib is matching these highs here, which are pretty much 187, 188. Looking at that, so there's a massive technical area coming here. We also got this trend line in play as well, again from the 90s, and I tend to only like trend lines when it's on real long-term stuff as opposed to shorter-term stuff. That comes in around 183, 183.10. So if we do kick on from here, there's a couple of big levels to keep an eye on. Obviously a few hundred pips apart, but sometimes these big levels, if they hit and hold, you can get a fairly decent reaction from them. So that's euro yen, big levels to watch in that one. Where else should we go? I was looking at dollar yen. So we're up. We've been up into the 156. It's come off the boil a bit since then. Dale was looking yesterday saying we could maybe get back up, or could we get back up to 158 going into the BOJ? At this speed, we absolutely could. We're going to need to keep an eye out on the Bank of Japan yen index. That was at 75.43 yesterday, still not out the woods. And let me just pick this up from our room that Mr. Brown put in, if I can find it. Oh, no, I can't. Hang on. Let's see if I can pop that out. Come on, why aren't you popping out? Oh, it's all going on pretty wrong. Right, let's get rid of that. Anyway, the yen index that we've been pointing out, that's at 75.43, still not out the woods. If this yen weakness today is maintained, then that is going to put pressure on that index. I managed to do it now. There we go. So we're still pretty low. These were the last times that MOF intervened. So this 75 level, 74.80s, I think, was around about the lows we got to last time. So yeah, if this yen weakness persists today, then that index is going to be coming back down low. Again, probably why there's been not much of a let-off from officials in Japan talking about rapid moves, FX moves, all that sort of guff. They really haven't taken their foot off that pedal, and maybe with good reason, because there hasn't been too much of a bounce over the last few days. So we are still potentially in intervention territory. Now, I would say, given that they haven't done anything before the Bank of Japan, they may be waiting for the Bank of Japan to see what happens with the yen. A hike is pretty much baked in, whichever way you look at it. So the first instance will be if they don't hike at this meeting, the yen's going to weaken, which then may cause them to step in. Conversely, as we are already priced in for a hike, there's probably not much room to see yen strength if we get that confirmation. So if we get a little, piecemeal move down in yen pairs, and then it takes off again after the BOJ because maybe they haven't said anything that's too hawkish and the market's bought rumour, sold fact sort of thing, then the yen pairs could take off. Yen could weaken significantly, and that's when the MOF could step in and intervene. So I think based on where we are on this yen index going into the BOJ, I think there's another risk point over the BOJ after the BOJ as to whether we get intervention or not. So you need to be very careful. I would not be thinking that selling yen pairs for a BOJ move could be sensible, because if that flips around, it could rally a couple hundred pips and then it gets spanked. So it could get done on both sides. But yeah, I think it's possible that the intervention risk is going to rise over the Bank of Japan meeting. So keep an eye on that. Dimi, unpopular opinion, Swissy yen could be a preferred short. Let's have a look at Swissy yen. If I've got it on here. Somewhere, anywhere? No, let's have a look at that one. Could be a preferred short when the yen decides to turn. I mean, I think you can put your hat on quite a few of them. If the yen is going to turn significantly, they're all going to turn. But yeah, this one might be open to that one as well. Mex yen could be another one. Could be another big mover. And you might be right. Pairs like euro yen might hold up a bit better if the yen turns, because obviously there's a bit of a bid in the euro at the moment. But yeah, this one hasn't mooched on to new highs yet, but it's still very bid. As we can see, that's been a one-way street all the way through. But your timing is everything, and you've got to account for the risk. Okay, if we're dealing with interventions and stuff, you're talking 200, 300, 400 pip surprise moves. Okay, so you need to be careful. I don't mind missing out on moves like that, because you can easily get spanked the other way if you're on the other side. I don't look at trades like that as a lottery win. I'd rather keep my account protected than try gambling on intervention. But you can get moments where you think, you know what, the risk is high, so I might go long a bit of yen somewhere, depending on the outcome. But I may even do that post BOJ if we get a massive rally in dollar yen or something after they've hiked. I might think about putting a little bit on, just on that intervention risk. But just be very careful. Keep your trade small. And if you think that the intervention risk is there, you certainly don't want to be the other side of it in a trade. Right, looking around some of the others, euro, dollar, absolutely nothing going on there. We're still stuck in this sideways action. We had a little mooch lower yesterday, got under the 30s level, back above the 30s level, can't go up, can't go down. So this one's still doing absolutely nothing. There is a big expiry going off on Thursday, between 115.90 and 116.10, just over 6 billion rolling off there. So we could find, given that this isn't going anywhere, we might have a little creep down towards the figure, depending obviously what happens at the FOMC tomorrow. So just keep an eye on that. It's a fairly lumpy batch of expiries, and in quiet times, that's when you can tend to see the options having an influence on the spot price. Would I sell it here on the back of the price moving to those options on Thursday? Would I sell it now? Absolutely not. But it would could be something that explains why that price might be glued around that area on Thursday. The opportunity potentially to trade that is seeing what the dollar's doing everywhere else. If, for example, we're down at 116 in euro dollar, but cables rallying, Aussie dollars rallying, every other dollar pair is rallying, or every other currency is rallying versus the dollar, but the euro staying stuck to a level, that would suggest that there's a bit of option influence, and then maybe once they expire, euro dollar will catch up. So if cables rallying, Aussie dollars rallying after the expiry, euro dollar might play catch up and start to rally as well. So those are the real sort of opportunities I look at when we've got big options in play, just to see if it's affecting putting prices out of sync with other pairs, other prices as well. Dollar CAD, that's been holding pretty much the 138 level down here. You can call it anywhere from sort of 138, the figure 138.20s. It's had a decent bounce. We're back above this 50 retracement, 138.40, and it's just trying to have a little hold there as well as we speak. So maybe we've seen a bottom in play. Who knows? This line up here will be important as well. If we can't get through there, that'll keep the downside in play. At the moment, we couldn't get that close, 8 pips away. So this bearish move is still valid as far as I'm concerned, but let's see what range develops. Obviously, the Bank of Canada tomorrow, so we might find that we just ping between the levels, depending on what else is going on in the world. Euro sterling, that's another test of the 87.20. As I was saying, the bounce from this one, not strong at all. Couldn't get through the 50s. I said there was a risk we come back down here. We've come back down here. We have held it again, but you know, this is going to be limited in time. Either we're going to break there or we're going to break here at 50s. Yes, we can go sideways for the rest of the week for quite a long period, but it's still a fairly tight range even for this pair to sit in for too long. So the more times we bounce off this level, the greater the chance of a break that is a bit of a runner if it happens. Same with the top side. So this one is on the fence at the moment. You've got this little sort of middling 87.38.40 area, which if we can't get above, we're not going to have a go at those 50s, and it keeps the pressure on the downside. So a little bit of a pivot developing in there. Let's have a look at gold before people tell me off for not looking at gold. And what's that been doing? Again, not an awful lot. We did have a little mooch out the bottom here. Couldn't get to this downside level, 41.60s, pulled up in the 70s. We're back in the box again. Is it going to have a look up the top, see what it can do? This one is very much in consolidation mode at the moment, has been for going on 2 weeks now. So no decisions here. If you want to trade the edges, that's fine. You can really only take direction if we're starting to break some of these levels and confirming it. I think that's very important for this one at the moment. You don't want to be selling breaks of levels like this only to find it flips around. Okay, so look for a confirmation, perhaps a move under, comes back, tests it and holds. That just doesn't mean it's not going to go back up, but you just want to try and increase the chances of you being right on a trade, because you know you can have these moments where it looks like it's breaking and then it's not. So this one's still sitting there. What's silver doing? I said we need to watch this level up here, these prior highs. We've had a little tap, it's held again. So you know, if you're looking at somewhere to short it, this is the level to short at the moment. And only if we're breaking these highs are you likely to be wrong. So it's pretty clear, you know, where you can enter, where you can put your stop. You don't have to risk a lot. The levels are showing up. This level here, 57.80, 85, still showing as a bit of a pivot point as well. We're holding above it, keeps the top side in play. So if you are thinking about a little short up here, you've got to get through here. If you can't get through there, then the risk is that we're going higher. So you know where you want to at least be taking partial profits, taking a slice off in case it doesn't go through. If it does, fine, then maybe get a move down here. But yeah, this is playing nicely between lines at the moment, and that's what you want in the techs. I'd say, balance of risks that this is looking, just based on this price action now, this is potentially looking to break higher, but level's a level until it's not. So if you can't get through there, you know what to do with it. I looked at yield quickly, but another quick look at the 10s. We got up close to that 420 level, come off a little bit now. Maybe the market's had its repriced, done whatever it wanted to do yesterday. And now we're just in the Fed orbit and just waiting to see what happens there. But again, this is going to be key. I know people are looking at this FOMC as being what they're describing as a hawkish cut, whatever crap that is. Just keep your eye on yields tomorrow and this 10-year over the FOMC. This will tell you what the dollar wants to do. Okay, if the market, if people, commentators, whatever, say it's a hawkish cut, but we can't get and hold through 420, then the dollar isn't going to last long on if it goes bid. So this is going to be a key, just as the same it's been key down here, this 4% level. Yeah, we've had knocks under to 490, but we couldn't really hold it, and then we got back in the box. Another little go here. We could have the same thing. It pops up 420s, 425s, doesn't last and comes back in. So this is your ultimate guide for the dollar tomorrow at the FOMC. Right, I have a quick look at oil. I haven't looked at oil for a while. Again, not doing an awful lot. It's trends within trends. We're still in a bit of a downtrend, but it's trying to recover somewhat, shall we say. But we're in a $2-3 range, so it's really not doing an awful lot. This one's still a bit at risk of anything we get from Ukraine and whatever. If there's no resolution, we're back to full-on war and Trump walks away and whatever, then there's a possibility that this might jump again on that news. But otherwise, we're sitting in the middle. And you've got to wonder for inflation, because give or take, oil has been pretty steady this year. Okay, we're not seeing any big wild moves. Yes, we've had these odd spikes and whatever, but throughout the year, we've stayed in this sort of 60s area, which will be having an influence on inflation as well. Doesn't mean it's going to come down, but it might mean that it's not going up as fast as well. Right, anything else for anything else, people? Let me know. I'm sitting here waffling on to my merry self. I need some input from you guys as well. What else can we have a look at? I don't know. Not much else to have a look at, really. Let's have a look at the Kiwi, see what that's doing. Let me guess, not an awful lot. It's keeping its bid, really, from after the RBNZ, but it's following what's going on in this dollar weakness that we've seen of late. Still can't get a move above this 38.2. So this is the trouble area at the moment. But dips are pretty shallow, so you've got to think if we're going to get a hold above here, it's going to kick on. 58.40 is a big old level above. We start getting into a bit of a zone here as well. It's also the 50 retracement, so this 58.40 level has had a fair few taps along the way going back. So it's going to be a significant level, and it's a bit of a zone, as you can see here as well, a sticky zone. So this is going to be a big old traffic area if we get up there, but we ain't going there unless we get above here first. And the longer that goes without happening, might see a bit of a pullback, maybe down to 57.50s, maybe a bit more, and then we'll see how strong this rally has been. We're still in this downtrend. Okay, so this is the first test of this downtrend, and it's I wouldn't say it's failing, but it's not breaking it either. So that's still one to keep an eye on. Euro Swiss, I'm keeping a close eye on. Let me get rid of that, because we could be having a move up to the top of this range that we've had in play for the last couple of years. We had a break out the bottom and all this stuff. We got back into it. This top side area, 43, 94, 40s, is a very strong area. It's been holding several times this year, so that's going to be a big area as well. Again, it's around the 50 retracement, so it's a level there as well. If we can't get through there, we might be staying in the box. As you know, both me and Kay had little goes down here on these lows. I might have a think about having a knock up here, depending on what's going on when that happens, just to play the range, just to play the text and see what's happening. That if it stays in play. Right, that's it. I'm going to call it a session. As I say, I'll try and keep you up to date on what's happening with the flow show tomorrow, but just be prepared in case we can't get it on. Have a great day, everybody. Take care, trade well,